If you've been anywhere near the market lately, you can feel the emotional whiplash. The last few weeks have been, well, they've been brutal. Bitcoin recently plunged sharply below that critical $100,000 mark, and the fear and greed index, it just collapsed. Absolutely collapsed from what, a high of 74.
All the way down to a terrified 24.
Deep greed to extreme fear.
And that swing, that massive swing from euphoria to panic,
Hmm.
is really the core paradox of our deep dive today. Because if you set the price action aside for just a minute,
And look at the fundamentals.
exactly. If you look at the fundamental backdrop, it is remarkably strong. I mean, you have the Fed signaling easing rates. Major crypto legislation has finally passed.
Right. And those altcoin ETFs are just waiting in the wings.
The mechanics are pointing toward, massive structural opportunity, but the market mood, it's pure, unadulterated panic.
Okay, let's unpack this. What we're looking at is a really striking divergence between, let's call it acute retail fear and clear institutional opportunity. Is this just a classic trap designed to shake out weak hands, or is the bull market genuinely broken?
That's the question.
Our mission today is to look past all that overwhelming emotion, use the sources you shared, and really find the mechanical and psychological truths that, well, that separate the winning 20% of traders from the 80% who just inevitably lose money. And I think we have to start inside the skull.
Absolutely. No amount of technical analysis, none of it matters if you don't first acknowledge human nature. Markets have always been ruled by just two simple, powerful forces.
Fear and greed.
Fear and greed. This pattern is ancient. I mean, it dates back to the Japanese rice merchant Hamarminisa in the 1700s, who started tracking these emotional tides.
With candle charts, right?
That's where they came from.
So when we look at a candlestick chart today, we're not just looking at price, we're actually looking at a history book. A record of when people felt optimistic and when they felt terrified.
Precisely. And this leads us to the philosophical side of trading. Prices are not objective. They are a reflection of collective belief. Value is subjective.
Meaning, if enough people believe Bitcoin should be $100,000,
Then that belief becomes the price. It's why Warren Buffett's timeless principle is the ultimate guide here. You have to be greedy when others are fearful, and fearful when others are greedy. It sounds so simple.
but actually doing it, executing that principle, that is the hardest thing in the world, right? Because it forces you to act directly against your deepest programming.
It does. And that's because of all these cognitive traps. The biggest one cited in the sources is loss aversion.
Ah, yeah.
Researchers have actually quantified this. The pain of losing money is roughly twice as powerful as the pleasure of making an equivalent amount.
So if you're up, say, 50% on a trade, and then it drops to only 25% profit, you don't feel 25% happy.
No, you feel 75% pain because you lost that potential gain you were anchored to. That emotional bias is exactly what the market exploits.
The blind spot is so powerful, and it brings us right back to what just happened. That November 2025 sell-off felt brutal, but you argue it was a market that was, quote, purged by forced selling, not broken by fundamentals.
Yeah,
Who was doing the purging?
it was coordinated profit-taking. We can clearly identify three groups that initiated this whole move. The first one, institutions.
No surprise there.
After months of consistent inflows that fueled the rally, the spot Bitcoin ETF suddenly saw billions in outflows through November. Billions.
So the big money was selling into strength while retail was still buying the highs.
In many cases, yes.
Yeah.
The second group were the OGs,
Yeah.
the long-term holders.
The early believers.
Exactly. And this new ETF liquidity finally gave them a perfect exit ramp to cash out serious sums without just crashing the whole thing. The on-chain data showed heavy distribution. These long-term holders were sending roughly $293 million worth of Bitcoin to exchanges
Per day.
every single day for weeks. That is a jaw-dropping amount of supply hitting the market.
That's astronomical. And I assume the third group was the most painful one for the individual trader?
That would be the highly leveraged traders, yes.
Yeah.
Once Bitcoin broke below that critical $100,000 psychological level, the automated margin calls and cascading liquidations they cut in.
So it's a sequence.
A sequence. Institutions and OGs took coordinated profits, which pushed the price down just enough to trigger the leverage cascade. And then the retail panic simply fueled that final flush, making the whole drop look much worse than the underlying health suggested.
Okay, here's where it gets really interesting. If we're supposed to follow Buffett's advice and buy into this kind of fear, we need reliable thermometers. The most popular one we all stare at is the Crypto Fear and Greed Index. What do we need to know about its utility?
You need to know that it is a surface-level index. It updates only once a day, so it's only good for measuring broader, long-term sentiment. It's not for quick trading signals.
And it's built from what? A mix of things.
Whole weighted mix, yeah.
Yeah.
It looked at market volatility, trading volume, social media buzz, Bitcoin dominance, and Google search trends.
And what does it show us when all those inputs align in panic mode?
It creates a really clear profile of fear. During extreme fear, two things happen. Trading volume just dries up because no one wants to enter the market.
And capital flees to safety.
Right. Capital flees the riskier assets, the altcoins, and it pools into Bitcoin as the perceived safest asset. That pushes BTC dominance higher. We saw dominance climb rapidly past 61% during this recent dip, which is a textbook signal that the crowd is nervous.
So if a listener wants a free, real-time indicator that tracks sentiment, what should they be looking at instead of waiting for a daily index update?
Google Trends is incredibly useful, but you have to use it correctly. You can separate the crypto natives who are, searching for specific altcoins or DeFi terms
Or from tourists?
from the tourists who are searching for generic phrases like buy crypto or what is Bitcoin. A rise in those specific altcoin searches is often one of the earliest hints that the retail audience is waking up and getting adventurous again.
But let's tackle the biggest drawback of all these retail sentiment tools, which our sources call the tourist problem.
Right, the fatal flaw. It's recognizing that this sentiment data represents a tiny and often misleading slice of the market. Every cycle, a flood of newcomers arrives, the tourists, and they completely disappear the moment prices start to fall. They never become active community members. The data we analyze only captures the tiny fraction of traders who actually stick around.
And I guess if these tools worked perfectly to predict tops and bottoms, their creators would be absurdly wealthy, right? Not giving them away for free.
Exactly. You can't rely on them alone. Because retail emotion is so easily distorted, we have to look past those surface-level indicators and examine macro sentiment measured through big on-chain data.
Okay, let's look at the king of those tools, the MVRV score. Can you break down what it is and why it's been such a historically reliable indicator of market extremes?
In plain English, the MVRV score compares the current value of Bitcoin, the market cap, to the realized value. And you can think of the realized value as the average price at which every single coin currently held was last moved.
So it's basically the collective cost basis of the entire market.
That's a great way to put it.
A low score means the current price is way below that cost basis, signaling mass capitulation. A great buying opportunity. A high score means euphoria.
That's how it used to work. Historically, the Z-score exploding into the red zone was a reliable top signal. But here is the critical structural change of this cycle. Even as Bitcoin reached new highs recently, the Z-score remained unusually muted. It didn't explode. Why?
The institutions.
Precisely. Institutional flows now dominate. We need to clearly understand what DATs are, digital asset treasury firms, and the spot ETFs. These entities aren't momentum traders.
They're not chasing euphoria.
No, they are systematic, consistent buyers. They average in, they buy every dip, and that dampens the old parabolic emotion-driven melt-ups we saw in 2017 or 2021.
So the structural conclusion here is that the MVRV score is now more reliable for identifying bottoms, which still require that brutal retail capitulation, than it is for pinpointing tops because the institutions are constantly absorbing supply.
That's the key takeaway. It's a tool that has fundamentally changed its function.
Speaking of top signals, before we leave macro data, let's quickly discuss the PI cycle top indicator. This sounds super technical when you read the calculation. What's the simple function of this alarm bell?
Forget the math. Forget the 111-day and 350-day averages. The function is simple. It measures when price appreciation has become too fast, too aggressive, and mathematically unsustainable.
So it's an alarm clock.
It's an alarm clock that goes off when the market is accelerating at an extreme rate. And historically, it has flashed within days of previous cycle peaks.
The lesson from all this data, from sentiment indexes to on-chain, seems to be that context is king.
Absolutely. Sentiment data without context is just noise. You cannot rely on any single macro indicator. Strong project fundamentals and a passionate community can completely override broader macro sentiment. A great example from the sources is the project Casper.
Right.
It managed to deliver a staggering 700x return during the brutal 2022 to 2023 bear market. It completely defied the cycle sentiment. That's a powerful reminder.
Okay, let's smoothly transition from emotion, which we've established is easily manipulated, to the automation that does the manipulating. This brings us to smart money concepts, or SMC. If sentiment is often the victim, SMC is kind of the playbook for the perpetrator.
That's a good way to put it. SMC argues that markets are not a level playing field. They are dominated by institutions, large funds, and elite algorithmic traders. And their primary goal is to exploit what they call the dumb money.
Us, retail.
Us.
So what does the smart money actually do?
The mechanism is simple and, frankly, predatory. Smart money knows exactly where retail clusters its stop losses. They use algorithms to push the price directly into these highly concentrated liquidity zones,
Which triggers a massive cascade of liquidations.
and simultaneously allows them to harvest all those cheap orders left behind.
That sounds like a cruel game. How does this create that paradox we often see, where a sudden pump or dump just seems to defy all logic?
It creates the opposite of what you'd expect. If smart money sees overwhelming bullish retail sentiment, meaning everyone is opening new long positions, they often use that expectation to trigger a temporary bearish move just to liquidate those longs.
And vice versa if everyone's short?
Exactly. They don't need massive force. They just need the right nudge at key support and resistance levels where all that liquidity is concentrated. That the sudden flash crash you see on a chart. That's pure mechanics, not human fear.
Let's detail one specific mechanical trap that is completely detached from retail emotion: the CME gap.
Right. So the CME, the Chicago Mercantile Exchange, is the main institutional gateway for Bitcoin futures, and it closes on weekends. Institutions run complex strategies like basis trades, buying spot Bitcoin while shorting futures to capture a predictable yield.
So if the spot price moves sharply over the weekend while the CME is closed, their whole hedge breaks.
Exactly. When the CME reopens on Monday, institutions have to rebalance their positions aggressively, which causes instant volatility as they rush to buy or sell spot to bring prices back in line. The result is that the gap between the CME's Friday close and Monday open gets filled roughly 70 to 90% of the time, regardless of what retail traders are posting on X.
So the critical takeaway for you, the listener, is that these gaps are mechanical magnets. You need to avoid chasing these moves with high leverage because you can get wrecked before the move completes if you bet against the mechanism.
Absolutely. Understanding the difference between mechanical price action and emotional price action is your greatest defense.
And now we arrive at the most crucial statistic of all. More than 80% of retail crypto investors lose money. The cause isn't a lack of access to charts or indicators. It's emotional decision-making, especially the reluctance to take profit. This all comes down to mastering the 6 inches between your ears.
It truly does. When prices fall from an all-time high, those cognitive traps, particularly anchoring bias, they kick in. If your portfolio hits $1 million and then drops to 500K, that $500,000 gain feels like a loss because you're anchored to that previous unrealized peak.
And the illusion of control, the feeling that you can time the exact top.
That prevents disciplined, planned profit-taking.
So how do we start thinking like a professional trader and fight this programming? We need a 2-part solution. First, mindfulness. Before you execute a trade out of fear or greed, pause and ask yourself 3 critical questions.
Those questions are, 1, am I taking profit or cutting a loss because it aligns with my plan, or am I just reacting to fear? 2, would I still buy or hold this crypto if I didn't already own it today? And 3, what would I advise my best friend to do in this exact situation? Removing the I helps eliminate the ego.
And the second part is discipline based on necessity. You have to anchor your selling decisions to real-world financial goals, not arbitrary round numbers.
This is so important. Don't decide to sell when Bitcoin hits $200,000 just because it's a nice round number. Decide to sell a specific portion, say exactly $15,000 when your portfolio hits a certain valuation, because that $15,000 is earmarked to pay off a student loan.
It links the decision to a rational, necessary purpose.
It removes the emotional euphoria or fear from the equation.
And that structured, tiered exit strategy must vary depending on the asset, right? Given the different stages of the market.
It has to. For Bitcoin, given the run we've seen, history suggests it's generally safer to be early than late in taking profits. For altcoins, however, many are still sitting near the bottom of a multi-year range, so a scaling strategy makes more sense. You should scale out gradually, maybe 25% at a major resistance level, then another portion at the next logical barrier. And finally, for the high flyers like ETH or Solana, you need to be strategic and front-run the crowd. If everyone expects ETH to hit $10,000 or SOL to hit
The
$1,000.
big, sexy round numbers.
Exactly. Your edge is in setting take-profit targets just below those thresholds. Target maybe $7,000 or $8,000 for Ethereum.
So you exit before the whales dump on the retail traders who are chasing that psychologically satisfying number but are inevitably too late.
You get out ahead of the herd.
So what does this all mean for you, the listener? The most sophisticated indicator in the world won't save you if you can't control your fear and greed. The recent crash below $100,000 was a planned shakeout disguised as a fundamental failure. Your greatest edge isn't finding the perfect tool. It's mastering your own mind and understanding whether a given price move is a temporary retail panic or a mechanical, coordinated liquidity hunt.
And to leave you with a final provocative thought, the dream of a sustained bullish run isn't dead far from it, but it is now entirely contingent on consistent institutional capital flow, particularly through DATs and ETFs. What implications does this increasing dependence on professionalized institutional structure have on future market volatility, and more importantly, the validity of those traditional cycle-top indicators that rely on massive, unmitigated retail euphoria? That's the structural shift you need to explore and understand next.